Okay, so today we're going to talk about why would you rather make 1% in real estate than 7% in stock? So the first thing we want to look at in discussing this is what exactly are we talking about when we say 1% versus 7%? So we've talked about this multiple times before. Ultimately, there's three main, the most tangible ways to make money in real estate. There's several others that are less tangible, probably more powerful. Let's talk about the tangible ones right now. Cash flow, mortgage pay down, and appreciation. Right, so if we're going to make 7% in stock and 1% in real estate, what does that really mean? Ultimately, what we're talking about is appreciation only when we compare those two. So when you see a media headline that says the market just increased by 1%, or it's gone up by 5%, or it's gone down 2%, or whatever that might be, ultimately they're talking about one variable, which is appreciation. And that's really important because when we look at three things, cash flow, mortgage pay down, and appreciation, it's a lot more than 1%. So let's just jump into our financials here for a second, and we'll show you what that means. When we look at these numbers, they're pretty conservative, right? We can do much better in the market as it is today, but let's take these conservative numbers. There's a 460 purchase price, 560 ARV, standard mortgage terms, standard P&L, even at a 0% appreciation rate, meaning the market is just perfectly flat, you're still making 8% with cash flow and mortgage paydown. That's really important, right? Now, when we go back to this idea of 1% versus 7%, we know now that if it was 0%, you'd still be making 8% over here. Now let's quickly look at what if I actually made 1% in appreciation. Now what does that do for me? Well, now I'm making 13%, right? So just looking at a couple of other variables, and there's more than this, a couple other variables, just cash flow and mortgage paydown, we know that we're making more like 8% or 13%. Even at 0 appreciation or 1% appreciation, we're making much more than we would in stock, right? So let's just take the 0 appreciation. So we're making 8% through cash flow and mortgage paydown versus 7% in stock. Again, just being very, very conservative. Now let's look through a different filter, which is what do we want to see in our asset class? As investors, what do we want to see? What evaluation criteria or success criteria do we use when we're looking at the investment class? So first, we would want to be able to see security, right? We'd want to evaluate based on that. Next, we'd want to be able to look at what is the effort required to produce wealth. And we want to look at ROI. What kind of return are we going to make? We'd also want to look at, what kind of control do we have? And maybe one of the most important variables that we want to look at is repeatability. Now, let's look across real estate and stocks, just see how they stack up across these evaluation criteria. So in security, in real estate, you've got brick and mortar, right? It's a building. Worst case, you've got insurance on in case something catastrophic happens. It's never going to be a vanishing, right, of that asset. It is a brick and mortar building. It's going to be there. You can drive by it. You can look at it. Not so much in stock. So on the security side, we're getting far less on the stock side. I've personally had stock vanish, not an ounce of recourse. So it's very, never had that happen in real estate. So the brick and mortar aspect of it makes the security higher on real estate than it is in stock. Now let's look at effort. And this is where stock can be less effort. Unless you're a day trader who's very, very active and kind of constantly buying and selling, the effort on the stock side is probably lower than it is on the real estate side. Now in real estate, we promote looking at it like a business. We're going to do as much to systemize things. We're going to try and streamline and be as effective as possible, but there is still effort there. It is still a business. On the ROI side, so we just looked at a 0% appreciation, but an overall 8% in real estate versus 7% in stock. Now, if you get 1% appreciation, now you've got a 13% overall in real estate versus a 7% in stock. And we know over the last 50, 60 years, we've been 5+% in appreciation. So let's just take a quick look at that. 5% in appreciation means we're getting a 34% overall return. And again, these numbers are very conservative. We're looking at much better purchase price and stronger ARVs. than what we see here. And so 34%, we've seen historically our assets do much better than that in the select markets that we choose in the GTA. And so ROI, you can get much, much stronger ROI in real estate, relatively speaking, than you can in stocks. And control. So this is where you get a big differentiator. Control in real estate, I can buy a single family home and turn it into a duplex. I can buy a multifamily and turn 1 bedrooms in that multi into 2 bedrooms. I can renovate and gut the entire thing. I could rezone my lot and build double the units on that lot, potentially, depending on the area and the property. Ton of control over the asset. And that is pretty big when we evaluate an asset class and say, is this worth sinking your money into? Not so much on the stock side. I can buy and I can sell. Those are my 2 main levers, my 2 main moves. I can do research. I can try to understand the executive team. I can understand the market position, but the control that I have over it, that's largely out of my hands. Now, one of the most important ones is the repeatability, the predictability, the scalability aspect of things. So in real estate, we talk about this quite a bit. The market that we're in right now, and especially in the Golden Horseshoe, the geographic region that we're in is very, very unique. And the market that we're in allows us to be able to produce, and we have to create these often through secondary suites, but it allows us to be able to predictably and repeatably produce this type of return that we just saw on the spreadsheet in real estate right now. So in 15 years, will we be able to? Not in this area. I don't think so at all. And there's a lot of market drivers that are speaking to that answer, right? Will we be able to do this? And the old adage in real estate, when's the best time to buy? Well, it's either today or 15 years ago, holds true. Absolutely, 100%. We even saw it in the spring of 17. The market, we were starting to get priced out of our key markets in the Golden Horseshoe, so we were moving further away. Luckily, there was a correction, and the buying experience is much better. Now we can reproduce these numbers again in a more repeatable, consistent, predictable manner. So you get a lot of repeatability, not so much in stock, unless you're going to sacrifice a lot of your return. So if you lower the return down lower than 7% in many cases, then you can start to get predictability out of it. But why would you, right? When you have an alternative of real estate where you can get even better returns and predictability, well, that's obviously a much more preferred path. So this speaks to, how we're able to make money in real estate, how we evaluate an asset class. But ultimately, there was a study published, I think a year and a half ago now, and it was a 150-year study over the last 150 years in 16 of the major economies around the world. And it evaluated all types of investments, and real estate had performed everything. Now, that is an extremely comprehensive study, 150 years across 16 major economies across the globe. I mean, this is a good understanding of why we prefer real estate, but that study says it all, which is real estate outperforms all across that time frame and across different areas around the globe and across different investments. And so very, very powerful. Hopefully this helps you understand when you hear 1% versus 7%, again, as investors, we need to have more insight than that. And hopefully this provides a bunch of that insight for you.